Global markets are on another run. Signs of a US recovery have eclipsed the problems caused by natural disasters in Asia and civil unrest in North Africa and the Middle East. It's triggered another burst of support for the Australian dollar, which rose above 104 US cents, its highest in almost 3 decades. The strong dollar will make life harder for the country's exporters, but easier for the Reserve Bank, which considers interest rates at tomorrow's board meeting. Here's Philip Lasker.
It'll take more than a Japanese nuclear disaster or unrest in some of the world's major oil producers to shake off the financial market optimists.
The global recovery is well on track. If anything, it's picking up pace. It's becoming synchronised across the industrialised and the emerging economies. And this year we're now facing the biggest risks to the world economy and financial markets are actually inflation risks as opposed to the financial problems that really dominated last year.
Optimism about global growth, helped by a falling US unemployment rate, means optimism about commodities. The Australian dollar responded accordingly, going above 104 US cents. And analysts are divided on where it's headed from here.
My view is it's getting a bit overdone here as we trade towards the 1.05 level.
I think 110 looks very, very achievable and probably appropriate.
Not to those here at this tourism conference trying to sell Australia to the world. Even Qantas chief Alan Joyce, who's cashing in on Australians going offshore, sees a downside.
A very strong Australian dollar in the longer term is detrimental for the tourism industry inbound.
And analysts are warning businesses of a new longer-term reality where parity is the norm.
I'd say, new paradigm thinking. Start thinking about the currency centring itself around 1. And the low side for the currency being closer to 90, 95.
I think our operators are trying to be as competitive as they can. They absolutely recognise that they've got a challenge.
When it comes to the Australian dollar, the Reserve Bank is about as non-interventionist as you can get. It views the strong dollar as helpful in keeping the pressure off inflation and therefore interest rates. It's one of the reasons the RBA is expected to keep interest rates on hold at tomorrow's board meeting. On the one hand, it'll see the number of job advertisements continuing to rise in March, leaving ads almost 20% higher for the year, pointing to a resilient jobs market. But a private sector inflation measure saw underlying inflation still well within the RBA's 2 to 3% comfort zone after a modest 0.3% rise. The numbers also showed a big 11.3% spike in fruit and vegetable prices because of Queensland's natural disasters.
Core inflation, when you strip out these volatile items, is still falling. And a big part of that is because the Australian dollar is up. Competition in the retail sector is intense, and we're not seeing these inflation pressures in an underlying sense pick up yet. So that gives the Reserve Bank some scope, some breathing space.
While the inflation number tells you the RBA has time to act on rates, the job ads numbers suggest interest rates will go up when time runs out.